To effectively fund both your emergency reserve and short-term goals, you must pay yourself first. This means prioritizing savings as soon as you receive your income, not waiting to see what's left over. The most effective tool for this is automation. Set up direct deposits from your paycheck to go directly into your designated savings accounts. You can also use apps that round up your everyday debit card purchases. Regularly review your budget to find areas to cut back, even temporarily, and redirect that money toward your savings targets. Remember, consistency is far more important than the amount. Saving $25 every week builds discipline and compounds into significant sums over time, creating powerful financial momentum. Alongside your emergency fund, you should actively save for short-term goals. These are planned expenses you anticipate within the next 1 to 3 years, such as a vacation or a new laptop. The key is to break these goals down into manageable, monthly savings targets. For example, if you want a $1,200 vacation in 12 months, you need to save $100 per month. Create a separate savings bucket or account for each specific goal. This method, often called sinking funds, prevents you from dipping into your emergency fund for predictable expenses. It helps you avoid using credit cards, keeping you on a cash-based, intentional spending path. An emergency fund is your financial safety net for unexpected expenses. For most people, the initial goal should be to save $1,000 as a starter fund for minor repairs or copays. The ultimate target is to build a reserve of 3 to 6 months' worth of essential living expenses. This protects you against major events like job loss. To start, open a separate, easily accessible savings account and automate a small transfer from each paycheck. Treat this contribution as a non-negotiable bill for peace of mind. Modern banking services are crucial for smart money management. Online and mobile banking allow you to deposit checks remotely, transfer money, and pay bills electronically. Take advantage of tools like budgeting apps offered by many banks. For security, always enable two-factor authentication and be wary of phishing scams. A savings account is for storing money you don't need immediately, helping you build a financial cushion. Unlike checking accounts, savings accounts earn interest over time. Federal regulation limits certain withdrawals to 6 per month. To build savings effectively, automate a transfer from checking to savings each payday. A checking account is your financial hub for daily transactions like paying bills and using your debit card. The key to managing it is avoiding costly overdraft fees. Set up low balance alerts and consider linking a savings account for overdraft protection. Always monitor your balance and pending transactions regularly. Responsible credit use means leveraging credit to build a strong financial profile without overextending yourself. Pay every bill on time and keep your credit utilization ratio below 30%. Good credit secures lower interest rates and can affect renting or employment. Start with a single card for small purchases you pay off monthly. Your credit report is the detailed ledger behind your score, compiled by 3 major bureaus. Review your reports regularly for errors or signs of identity theft. By federal law, you are entitled to 1 free copy from each bureau every year at annualcreditreport.com. If you find an error, dispute it directly with the bureau. Your credit score is a 3-digit number lenders use to gauge your risk. The higher your score, the better the interest rates you're offered. It is calculated from your credit report, with key factors being payment history and amounts owed. You can check your score for free through many bank apps. For long-term goals like retirement, use tax-advantaged accounts. Common options are employer-sponsored 401ks and individual IRAs. Contributions to a traditional 401k or IRA are often made with pre-tax dollars. Roth versions are funded with after-tax money for tax-free growth later. To avoid picking individual stocks, many investors use mutual funds and ETFs. These pooled funds offer instant diversification, which significantly reduces your risk. Buying one share of a total market fund gives you ownership in hundreds of companies. They are practical tools for building a solid investment foundation. Investing begins with understanding stocks and bonds. Stocks represent ownership in a company, offering high growth potential with higher risk. Bonds are loans to a corporation or government, providing steady income with lower risk. A balanced mix of both aligns with your risk tolerance and time horizon. Social Security provides a foundation of retirement income based on your lifetime earnings. You can start benefits as early as 62, but your payment will be reduced. To receive your full amount, wait until your full retirement age, which is between 66 and 67. Delaying benefits up to age 70 results in an increased monthly payment. A 401k is a powerful tool offering tax advantages and often an employer match. Always contribute enough to get your employer's full matching contribution. It's free money. Contributions are taken from your paycheck before taxes, reducing your current taxable income. Withdrawals before age 59.5 typically incur a penalty plus taxes. IRAs offer another avenue for tax-advantaged savings, useful if you lack a 401k. The two main types are the traditional IRA and the Roth IRA. With a traditional IRA, contributions may be tax-deductible now. Roth IRA contributions are after tax, but qualified withdrawals in retirement are completely tax-free. Putting it all together integrates daily habits with long-term pillars. Your budget should allocate funds for retirement, taxes, and estate planning. Use automation to fund investment accounts right after payday. Schedule an annual financial review to reassess your budget and rebalance your portfolio. Estate planning dictates what happens to your assets and dependents. At a minimum, create a will and name guardians for minor children. Establish durable powers of attorney for finances and healthcare. Regularly review and update the beneficiaries on your retirement accounts and insurance policies. Proactive tax planning minimizes your lifetime tax burden. Use tax-advantaged accounts and be mindful of capital gains taxes on investments. Adjust your W-4 withholdings at work if you consistently receive large refunds or owe money. Your goal should be to break even. Homeowners or renters insurance protects your dwelling and belongings. For homeowners, insured dwelling coverage is enough to rebuild at current costs. Renters insurance is affordable and covers your personal property and liability. Life insurance, like term life, provides for dependents if you pass away. Auto insurance is legally required. Liability coverage pays for damage you cause. State minimums are often too low, so increase these limits. Consider your car's value when deciding on collision and comprehensive coverage. Shop around every few years for potential savings. Health insurance is a critical financial safety net. Understand key terms: the premium, deductible, copays, and coinsurance. A higher deductible usually means a lower premium. Always check if your preferred doctors are in network to avoid higher charges. Start by defining clear long-term goals, like retiring at 65. Then, work backward to establish the needed monthly savings rate. Automate these savings transfers immediately after each paycheck. This is the most powerful habit. Your daily spending then occurs within the remaining budget. Create a one-page financial dashboard listing your net worth and key documents. Review this quarterly to ensure your daily habits fund your future vision. Estate planning ensures your savings benefit the people you care about. It's for anyone with assets, like a home or retirement funds. Verify all your beneficiaries annually and ensure your key documents are accessible to trusted family members. This includes your will and powers of attorney. Understanding taxes is non-negotiable. Maximize contributions to tax-advantaged accounts like 401ks and IRAs to reduce taxable income now. For non-retirement savings, consider tax implications. Holding investments for over a year typically qualifies for lower long-term capital gains rates. Do an annual tax checkup with your pay stubs. Ensure you're not having too much or too little withheld from your paycheck.